Well, hello, everyone. Welcome back to our Centennial Speaker Series. The series was such a success in 2020 that we will continue offering the sessions virtually through at least the next few months. Thank you all for joining us for this event featuring Joseph Calandro Jr. My name is Donna Rapiccioli, and I have the honor of serving as the Dean of Fordham's Gabelli School of Business. Purpose-driven business education is at the heart of Fordham University. And since our inception, we believed in the power of partnerships to inform and lead change. So once again, today, I'd like to very much thank the Gabelli Center for Global Security Analysis and our wonderful partners at the Museum of American Finance and the CFA Society of New York, who are all sponsoring today's conversation. The Centennial Series was designed to shine the light on important topics, trends, as well as the importance of history in forecasting the future. Today's presentation will discuss Jason J. Gould, American Railroad executive, his skills as a corporate leader following his distressed investment in and subsequent control of the Union Pacific Railroad. Joe will explain how Gould's example serves as a very important historical reminder that successful executives do not require government bailouts. Today's session will take place in three parts. First, David Cowan, President and CEO of the Museum of American Finance, will introduce Joseph Calandro Jr. Then Joe, a familiar guest, will discuss Jay Gould and the Union Pacific from the Panic of 1873 to 1880. Following Joe's discussion, David and I will facilitate audience questions, which we ask that you type into the Q&A section near the bottom of your Zoom screen. Joe will try and answer as many questions as possible during the session. Before I turn it over to David to introduce Joe, I want to take a moment to remind you that we depend on you to advance our missions and ask that you consider making a donation to the Gabelli School Centennial Fund and to the Museum of American Finance. Now it is my pleasure to turn the Zoom screen over to David.
Thank you, Donna, and it's great to be back for the 2021 season. And what a perfect way to kick it off with Joe, because he checks both the Fordham and the museum boxes. And he is a fellow at the Gabelli School for Global Security Analysis. And with respect to the museum, has not only spoken several times, as you mentioned, but also written multiple times for our own magazine, Financial History. And that's just the start of his writing credentials. He's got over 50 scholarly articles in financial journals, such as the Journal of Private Equity, the Oxford Journal of Finance, and Risk Perspective is a second one. Joe's the contributing editor of the journal Strategy and Leadership, and his most recent book is Creating Strategic Value, published in 2020 by Columbia Business School Publishing. And if that's not enough to keep Joe busy, he's also a managing director of a global consulting firm. And what I like about Joe is he's not only just well-versed in current events, but also in history. And with all the news about GameStop and other stocks, what a perfect time to talk and discuss about Jay Gould, a figure from Wall Street history who might know a thing or two about market craziness. With that, I hand it over to our friend, Joseph Calandro Jr.
Thank you, David. I appreciate it. And welcome to you all. If I'm speaking to you from the Northeast, so like many of my listeners from the Northeast, am completely snowed in. That makes these video presentations all the more convenient, because if this was in person, it would likely be snowed in. But with that, I'm going to share my screen. And this is the cover page to our talk today, Jay Gould and the Union Pacific Railroad from the Panic of 1873 to 1880. The picture on the lower right is just a photograph from a periodical at the time showing the kind of the volatility emanating from the financial panic. And the photo to the left is the subject of the talk today. That is a photo of Jason J. Gould. Please keep this photograph in mind as we continue with the presentation, because no one in United States financial and business history is as misunderstood and underappreciated as Mr. Gould. even amongst some business and financial historians who theoretically at least should know better. So for example, I've included on this slide 3 quotes. I'm keeping them anonymous at this time. They're all by very credentialed and respected business and financial historians. And this will give you a flavor of some of the misconceptions about Gould over time. So the first quote basically compares Gould to Mephistopheles, who was the demon that Faust in the German legend sold his soul to. Clearly silly to refer to somebody as the demon of Wall Street. But again, it kind of sets the tone. Moving on to the second quote, this is a quote by a very accomplished financial historian. And it refers to one of my 3 favorite business and financial history books, The Life and Legend of Jay Gould by Maury Klein. You can see a photo of that book in the upper right of the slide. This particular author criticizes the book by calling it a revisionist history. Now Maury Klein is not only a friend of mine, a good friend of mine, he's a historian. And one of the roles of the professional historian is to search out potential research topics, both with respect to what's been said, as well as what hasn't been said, given the fact that new materials have been found. That's kind of a key topic. So if a historical figure such as Gould has been covered ad nauseum, and people are just saying the same things based on the same materials, there's really not much to say. And we see a lot of that with political figures over time. But in this case with Gould, Professor Klein uncovered a wealth of material that hadn't been looked at by historians before. And I know that not just because he is a friend of mine and he told me that, but when you turn to the first page of that book, in the preface, the second paragraph, Maury says it. There's a great deal of information that hasn't been looked at yet, and it required a reevaluation rather than just a simple revision. A professional historian should clearly know that. The second criticism here is that they're questioning Gould's deserved reputation as a quote unquote notorious manipulator of stocks. Now, as David said earlier on, there's been a lot of talk about quote unquote manipulation lately. It's important to understand that Gould is a product of his time, just like we're a product of our time. He's a 19th century man, and he played the game as he found it, just as we all play the game as we find it. Gould was exceptionally good at the game that he played, and he frequently won. And that takes us to the third criticism. And as you can see here, it basically says, Gould certainly was ahead of his time, and his rivals despised him because he beat them at their own game, which was true. But then the author here goes on to say that Gould made a mockery of the supposedly self-regulating capitalist system. And look, as a business economist, when I hear things like this is one of my pet peeves, right? So just by way of background, and very simply, all capitalism is a system of voluntary interaction between 2 or more people without any outside interference. So if David and I were trading, or I was selling something to him, or David and Donna were trading or selling, the transaction would be between both of them and them alone, no one else. On the opposite side of the fence is socialism, which is a system of 100% government control over everything economic. Now, they're both theoretical constructs. This country has never been purely capitalistic, even when it was founded. When Alexander Hamilton was Secretary of the Treasury, he assumed the wartime debt of the states, and he assumed it at par. There were both winners and losers of decision like that. And again, I'm not being critical or supportive of it. That's just a fact of what he did and what the consequences were. And government intervention or participation in economic affairs didn't stop there. In the 19th century, government was very active in the economy via tariffs, war financing and spending, as well as internal improvements such as canals and railroads. And that kind of continued, obviously, into the 20th century. Since the late 20th century, however, massive government bailouts of failed firms have unfortunately become quite commonplace. One of the rationales for bailing out failed firms during periods of financial distress, excuse me, is the argument that if governments don't intervene, the failures will exacerbate the distress and cause it to spread further, possibly to the point of a total economic collapse. However, in the 19th century, governments didn't do that, and their economies obviously didn't fail. In fact, some of the firms that were in distress during a panic were eventually turned around and then went on to perform at even more profitable levels. And this presentation profiles one such case following the infamous panic of 1873 involving Jay Gould's distressed investment in and managerial control of the Union Pacific Railroad. In his turnaround of the UP, Gould employed many modern techniques that are relevant to 21st century historians and executives alike. So moving on, this slide profiles the framework we're going to use to evaluate Gould. It's taken from my recently published book, Creating Strategic Value, and I'm not going to explain here each one of the 6 steps because I'll do that as we move through the slides. I do want to say, though, that each one of these characteristics, they build on each other. So look at them linearly. You kind of need all 5 to get to powerful returns that compound over time, which is the last one. So again, I'll explain some of this as we go forward, but for now, just keep that in mind that these things do build on each other. So the first topic we'll look at is strategy and the margin of safety. And strategy can mean many things, but from a corporate strategy and corporate finance perspective, it tends to mean 2 things. One, the value proposition a firm offers its customers to attract business. And then the second is a statement of differentiation. So how are they going to deliver that value different than competitors? Now, those 2 things sound very simple. They're not. They're very, very difficult to do, which is why you don't see any truly unique strategies in the marketplace today. One of the things we've done here is that we've combined a financial concept called the margin of safety into strategy. And all the margin of safety is, it's a theory of the best way to earn a positive return on your investments is to buy investments less than a conservatively derived value. So in essence, you're buying cheap and you're selling it when it gets more expensive. Again, sounds very simple to do. It is inordinately difficult to do, especially in a modern economy. Now, merging these 2 things together has some level of historical precedent. So one of my favorite books is The Art of War by Sun Tzu. The name is actually pronounced Sunza. And in that book, Sun Tzu makes it very, very clear that the best strategies are the ones that are the most economical. Now, in finance, the way you find assets that are selling for less than their conservatively derived value is during a financial panic. Now, ever since the practice of fractional reserves, banks have been at risk of sudden and intensive runs on their deposits. And if anyone has seen the wonderful movie, It's a Wonderful Life, there's a great scene in there of a run on the bank that Jimmy Stewart's character manages quite well. Now, if you add credit cycle dynamics to the mix along with fractional reserves, it's fairly easy to understand why panics have been a regular financial phenomenon across time. As a result of that, Jay Gould in the 19th century was just as familiar with financial panics as Warren Buffett, for example, is today. And similar to Buffett, Gould both protected himself from panics before they occurred, and he positioned his portfolio to profit from panics after they did occur. The panic of 1873 is a case in point. So prior to that panic, Gould was quite famously invested in the Erie Railroad, along with Cornelius Commodore Vanderbilt, and they went at it in a variety of things that's been termed the Erie Wars. At the end of those wars, the timing couldn't have been better. Gould cashed out. He was in a very, very strong capital position. He didn't just immediately look for something to allocate the capital to quote unquote put it to work. He held it and he waited and he watched what things were going on. And as a result of that, as one commentator observed, and I'm quoting here, getting out of Erie in a strong cash position on the eve of the Panic of 1873, Gould was ready to attack the Union Pacific, close quote. Now, again, right, like we have to be careful with language here. Gould was an investor, and he was also a trader, but in this case, he was an investor. He did not attack the Union Pacific Railroad. The only thing he did was he made a distressed investment in the railroad securities at a very favorable price, or as professional value investors would say, at a margin of safety that arose out of the infamous panic. This is something that continues to be done by successful value investors today. So for example, in September of 2008, during the last financial crisis, Warren Buffett made a distressed investment in Goldman Sachs that has proven quite profitable over time, again, as the volatility of that crisis has dissipated. Gould went a step further than Buffett, however, because he assumed operational control of the Union Pacific to personally direct its turnaround and to realize the value of his investment. Business financing. In many ways, business financing or capital structure, the amount of equity and debt on a corporate balance sheet, is one of the most misunderstood and underappreciated of all managerial responsibilities. Far from being irrelevant, as some people may wish to think, especially certain economists, capital structure is at times the most relevant of all managerial considerations. And this kind of makes sense, right? If you're going to take advantage of the volatility generated from a financial panic, your own balance sheet can't be under distress from that financial panic. Because if it is, you're going to be a forced seller rather than an opportune buyer. And again, this has been the case across financial history. Therefore, responsible executives and investors across history have not put their firm's balance sheets at risk during boom times to ensure that those balance sheets will not come under distress during periods of mass panic. And as such executives and investors knew in the past and know today, there will always be a next panic. So you always have to be on alert. Now, that's important for a couple reasons. Number one, because it explains why it's set up how Gould was able to buy the Union Pacific at a favorable price. But number two, it also explains what he did later on to ensure that he made money from his investment and the firm didn't fail. Given the volatility caused by the panic, Gould realized that one of the first things, if not the first thing he had to do in his turnaround was clean up its balance sheet to restore its credit. In other words, to get it out of financial distress and put it on a solid capital platform, operating platform at that, to earn a positive return over time. He stated he was going to do this publicly, but his timing could not have been worse. So after the panic, the US economy slid into a very deep recession that was so severe, it was actually known as the Great Depression until the 1930s. And according to the National Bureau of Economic Research, it remains the longest depression in United States history. However, regardless of that quite troubling and volatile environment, Gould went on to restore the UP's credit, or the Union Pacific's credit, and much of it within a year, through a combination of aggressive negotiation with his creditors, innovative financing strategies, which included Gould assuming some of the UP's debt himself, as well as leveraging the relationships across his incredibly wide financial network. His example of doing this during a severe depression, no less, holds a great deal of lessons for modern historians and executives. And it's something that really generally hasn't been covered enough in the business and financial history press. So turning on to the third characteristic of investment, financing, and operational balance. One of the things when I was conducting the research on Gould, and I wrote about Gould in chapter 11 of my current book, and I've also written a couple of articles on him, as well as another one that's coming out in the museum's journal, Financial History. It was how incredibly diverse his skill set was, but how balanced it was. So, for example, it's pretty well known Gould was a successful investor, but he wasn't just an investor, he was also a trader. Um, it's very rare, even today, to find someone who can do both of those things equally well. So, for example, Warren Buffett today is obviously known as a preeminent an elite investor. Similarly, George Soros is known as an elite trader, speculator. Now, that's not saying Buffett's never traded and Soros has never invested. They have, but their styles are very well known. They're well known for one thing. Gould did both equally well, and he frequently transitioned from one to the other with lightning speed. He was also very good with financing, which we just discussed, rivaling J.P. Morgan, the banker, not the bank of today, in financing skill. But one of the things that certainly surprised me as I was conducting the research was he was also quite an operator. And his role as an operator has usually been ignored. So right now I'm going to quote the Union Pacific's official history, which says that Gould provided the UP with its first taste of effective, cohesive management by giving closer attention to every aspect of its operations than any previous author had done. Everyone knew of his genius for finance, but no one suspected his capacity for mastering every phase of railroad building, end quote. And his operational skill enabled him to discover new sources of revenue for the UP during his turnaround. It helped him to devise better ways to use the railroad's vast land holdings and to keep a close monitoring of costs, all of which contributed to an ever-growing bottom line. But more important here is his ability to deploy and, in some cases, simultaneously integrate top-tier skills across three very different functions: investment and trading, finance, and operations. Even today, such an ability is exceedingly rare and is only observed in some of the most accomplished executives. And we listed a couple of examples, like the Tisch family of Lowe's, Carl Lindner of American Financial, John Malone of Liberty Media, and Prem Watson of Fairfax Financial. There are others, I'm not listing them all, but again, there aren't many, right? There really aren't many, and there haven't been many over time. However, the need for these types of skills is increasingly being recognized. So, for example, the late legendary value investor Marty Whitman and his co-author argued in their 2013 book, Modern Security Analysis, quote, "Unlike others who view management solely as operators of business, we apprise managements of their competencies as operators, investors, and financiers." And again, that's a trend that we see continuing into the future, and Gould was very much at the forefront of it. Fourth is pertains to clarity and transparency, which may strike some of you as odd when we're talking about someone who's been accused of, quote unquote, being a market manipulator. How can you be kind of clear and transparent? Well, one of the ways that a professional value investor would view a manager is to look at them rationally. And rationality here is being defined as behaviors that reconcile with stated goals and objectives over time. It sounds, again, very easy to do, but it's remarkable the insights you get when you evaluate managers, as well as politicians, of course, on that standard. So, for example, in the earlier section, section 2, we talked about how Gould restored the credit of the Union Pacific during a recession, and much of it within a year following statements he made to that effect, which is a kind of a clear example of rational behavior. Now, that's not meant to imply that Gould was always clear and transparent. Then as now, the world of finance can be inordinately complex, and then as now, the most successful investors and executives selectively use complexity and financial obfuscation to enhance their positions. According to Maury Klein, it is the genius of financiers and lawyers alike to transform the simplest of propositions into a labyrinth and profit from the bewildering groping that follows, close quote. Jay Gould was an absolute master of financial labyrinths, similar to Warren Buffett and George Soros today, as well as other elite investors. In contrast to both Soros and Buffett, however, Gould has been pummeled mercilessly for his use of financial complexity and obfuscation. Now, one of the criticisms leveled against him in this regard is that he employed these tactics as a lone wolf on the hunt for his own interest and his interests alone. However, contrary to criticisms like that, Gould actually did form very close associations with colleagues that lasted his lifetime, and the slide gives two examples. So above, we noted that Gould leveraged his relationships across his wide financial network to restore the UP's credit. He would not have been able to do that if he couldn't be trusted, because if he couldn't be trusted, he wouldn't have a wide financial network that he could tap. Also, Collis Huntington, who was one of Gould's bitterest rivals, praised Gould's reliability. Quote, "I know there are many people who do not like him. I will say that I always found that he would do just as he agreed to do." Close quote. Again, Gould was rational when it came to business decision-making, strategic decision-making, and he was viewed that way by many of his colleagues, despite what's been written about him in the past. Which brings us to our fifth characteristic on humility. And when I give talks like this is the one topic that gets a great deal of attention for a couple reasons. I mean, number one, we're not living in exactly what I would call a humble time. The arrogance levels in politics on both sides of the aisle are at record highs. The arrogance levels in the media with the political court jesters, again, of both parties, is at record highs. We're seeing it at some universities, thankfully not Fordham. We're seeing it in business and Wall Street. But there are exceptions to that. So perhaps Warren Buffett's greatest example, at least to me, is that a person can be both an elite investor and a multi-billionaire without being personally arrogant. Similarly, and this is going to come as a surprise to many people, especially many people who view Jay Gould harshly, because Gould was remarkably humble, and in two respects. So first, unlike many so-called titans of both his age and ours, and many of the people referred to as titans at both Gould's age and ours are anything but titan, Gould lived a quiet, extremely private life unmarred by personal excess. He shunned so-called high society. He was devoted to his wife and 6 children, created an extensive library of books that he actually read, and built the largest privately owned greenhouse in the nation. Again, he was not interested in what other people thought, especially other people outside of his universe, and he prioritized his attention very, very carefully. That's a lesson that many people today can and should learn. Second, Gould's, and more importantly for our discussions here, Gould's personal humility extended to his approach to corporate management. And this is very, very important today. Again, I'm going to quote from the official history of the Union Pacific. Quote, "In management meetings, Gould never dominated discussion, but let it drone on before expressing succinctly and precisely the point others had been groping for. He did not command or dictate, but suggested politely. Far from being an imperious figure, he was content to dwell in the shadows and let others take the credit. For a man consumed by ambition, he was strikingly unaffected by considerations of ego or vanity." Close quotes. Now, humble managerial behavior like this helps to produce a positive work environment, which in turn helps to attract and retain talented employees, which in turn helps to increase the productivity of a firm. Productivity increases are important in any economic environment, but they're all the more important in a turnaround being conducted during a depression following a major financial panic. And Gould's results at the UP prove this out. I can talk a lot more about this subject in the Q&A to the extent anybody has any interest, but right now I want to talk to the compounded returns that Gould produced at the Union Pacific. And earlier on in the discussion, we talked about each of the 6 characteristics building on each other and being somewhat linear. At the end of the day, if you do those 5 preceding things correctly, you should be able over time now to produce an above average market return. And the way a finance person measures that is through the compounded return or compounded annual growth rate known as a CAGR. And judged by this standard, Gould's accomplishments at the railroad measure up incredibly well. So the UP stock from 1874 to 1880, which is generally when Gould managed the firm, the CAGR, compounded return of the price appreciation, there was 19%. Now that's an impressive return in and of itself, but all the more so when you compare it to the 7.5% compounded return of the New York Stock Exchange over the same time period. Now, to put what Gould did into context, it's important to understand 4 things. Again, the U.S. economy was in a major depression from October of 1873 to March of 1879, following the infamous panic. And some economists, such as my friend Mark Faber, suggest that the distress and depression extended for a number of years kind of past that. So in other words, from a macroeconomic perspective, like Gould was operating against considerable headwinds. Number 2, there was no quantitative easing or QE following the panic of 1873 because President Ulysses S. Grant refused to debase the national currency to stimulate a recovery. So Gould was also operating against significant monetary headwinds. And then third, and this is going to come as a surprise to many people today who are so used to the government bailing out failing firms and taking a very active role in the economy, especially during times of distress. Back then, not only did the federal government not offer bailouts to distressed and failing firms, but they also demanded the strict repayment of governmental loans from such firms. So contrary to popular belief, government loans issued to help construct the Union Pacific were not a subsidy, but a loan. And given the size of the loan, the UP was actually the government's largest debtor at the time. And the UP was one of the few railroads with a federal rather than state charter, which made it directly beholden to the US Congress. Now, what does all that mean? So as Gould was trying to clean up the UP's balance sheet, he broke it up into segments. The first segment was to get it out of immediate distress, to give his operational turnaround time to take hold and produce fruit, which certainly happened. But there was also a longer term aspect to it where he wanted to kind of restructure and renegotiate some of the debt contracts that were on the UP's books. Financial person would call that a workout. And despite how hard he tried, just dealing with all the various congressmen proved to be too much for him. He realized he couldn't do it. So in order to monetize the value he created at the UP during the turnaround, he just kind of sold his shares, similar to what he did with Erie. He banked it and then he looked for something else to do. And he was quite busy after that, at least until his premature death. So where does that leave us today? Conclusion. So for the past half hour or so, I have been talking about all the things Gould did right, and I don't want to leave any of you with the impression that he was perfect and never did anything wrong. Gould was human, just like we're human, and no human is perfect. We all make our mistakes, and we all have some of our strengths. However, with Gould, his strengths were magnified at his time, which incredibly carried over into our time and completely overshadows his various strengths. And there are quite a few. Again, no one's perfect. We're not perfect. He's not perfect, but there are a lot of strengths there. And again, as I was conducting the research, I came upon something that the late Benjamin Graham wrote. By way of background, Benjamin Graham is the preeminent thinker of the 20th century in finance. He's better known for founding value investing and teaching Warren Buffett how to invest. He's also the the father of all things value. I think he founded the CFA Society. So I mean, he was a remarkable man, and he also had an acute sense of history. And he said, you know, we have no right to reject the lessons of the past until we have at least studied and understood them. And that quote has always struck with me, and it resonated in my head over and over again as I conducted the research for this presentation and the article which is going to follow it. And as I was doing that, I came across in 2016 an article that journalist S.L. Mintz wrote on the railroad industry. And one of his findings, and I'm going to quote him, was for the 8 quarters through December 2015, most Class 1 railroads that returned capital to shareholders posted a negative buyback return on investment, or ROI. So in other words, close quotes, modern railroad share buyback initiatives resulted in a capital loss. Now, significantly, the Union Pacific was profiled in Mintz's study, and it was noted that they had generated a negative 15% buyback return on investment, which, you know, sharply contrasts with Gould's 19% CAGR on an absolute basis, but it becomes even more impressive, the difference between the two, when you consider them on a relative basis. So again, right, Gould generated a 19% CAGR while cleaning up a troubled balance sheet during years of depression, deflation, and with absolutely no government support, while the UP's modern negative 15% buyback return on investment was generated during a period of insanely easy money, asset inflation, governmental bailouts, all of which are kind of bullish for equity prices. Okay? So I'm gonna go out on a limb and say that if Jay Gould was alive today, he would not have followed the modern share buyback crowd, and the reasons why should be obvious by now. What should also be obvious, in my opinion, is the fact that, again, successful executives and investors across history, like Gould, have not put their firm's balance sheets at risk during booming economies, and as such, they neither need nor plead for governmental bailouts during times of financial distress. This is clearly a lesson of the past that we should not reject until we study it. And in my opinion, today it should be studied intensively, because there's a great deal we can all learn from it. So with that is the conclusion of my prepared remarks. I will be happy to take your questions. I hope you all enjoyed the presentation, and I hope you all will consider donating to the Gabelli Center and Fordham, as well as to the museum, so they can continue doing the great work that they are in these crazy times of ours.
Thanks, Joe. That was terrific. Much obliged, and thank you for the shout out. We do have a number of questions. The first one, I'm going to combine two because they're both from Anonymous. Adam Smith might disagree with your characterization of capitalism. In Wealth of Nations, governmental authority had a very important role to play in economic activity. And I'd like to combine that with another question, which basically says, do you think the markets need more governmental regulation?
Yeah, so two things, right? I am in complete agreement with many of the things Adam Smith said, right? Capitalism, as I said, is just a system of voluntary interaction. I did not say there was no role for government there. Socialism is a system of 100% governmental control. I am obviously not for that. The question is, and this country has always been some role for government in economic transactions. So the question is, what should that role be? Now, for my own opinion on this, before we talk about adding more regulation or taking more regulation away, or taking some regulation away, I think it would make a great deal of sense if we take an inventory of all the regulation we have that's on the books, find out where it all overlaps, rationalize it, discuss where we want more or less and why, and come up with a logical, rational approach. That is my position. That is not what's happening today. Hopefully, over time, sanity will take hold and people will begin to look at this more rationally. And again, begin with those types of inventories where things are working well, where things are not working well, and then remedy it. That should happen sooner rather than later. Financial wellness is becoming a very significant problem right now. It's the topic of my third book that I'm writing with a colleague, and it's a problem that's not going away. And one of the things that's partially responsible for it is the regulatory environment.
Thanks, Joe. I'll jump in here. We have a question from Richard. And Richard is asking, why do you give Gould a free pass after his plundering the Erie Railroad, one of the most egregious episodes in U.S. financial history? See Chapters of Erie by Adams Brothers. And also his plotting the 1869 Black Friday gold panic. So what do you think?
So again, right, I'm not giving him a pass. I am absolutely not giving him a pass. With respect to the Erie incident, I would encourage you to read what Maury Klein has written about the Erie and compare it to some of the other versions of it, and then make your own mind of what happened there. Again, the rules were different then. I'm not excusing what he did. I'm not supporting what he did. He did what he did during his time, just like we do what we do during our times. What was the second part of that question?
It was about the
gold.
Black Friday, 1869 Black Friday gold panic.
The gold corner. Again, right? I'm not giving Gould a pass with that either. He did what he did. Again, the rules were different then. Am I comfortable reading all that stuff? No. But again, he played the game as he found it. He played it to win. He was incredibly innovative around it. And there are lessons that can be learned with what he did kind of wrong, as well as what he did right. My position is, instead of just focusing on what he did wrong, also focus on what he did right. Now, this is the third or fourth time I said that. So please, please take it into consideration. I'm not giving the man a pass. I am saying be balanced in your judgment and look at the pros and cons.
Dimitri Kucher wants to know, did Jay Gould have the pressures of meeting quarterly return expectations that current companies have?
Oh, that's a great question. I almost think it's a plant. I mean, it's not, but that's a great question. Thank you for asking it. So we hear this a lot, right? Well, the market says this, the market says this. And one of the things in modern society is we've gone to bullet point excuses and explanations for very, very kind of complex phenomenon. And that's getting worse too. And then you add the arrogance factor on it and you cannot make heads or tails of any of it. So earlier on, when I talked about strategy, I mentioned kind of the two central characteristics of business strategy: customer value proposition and a differentiation statement. So how are you going to deliver value differently than your competitors? Like, those are the two things. It's very difficult to find a firm that meets those two things. And then if you add on margin of safety on top of it, the universe of firms gets even smaller. That question begs the issue, like, what is the role of the modern firm? Is the role of the modern firm just to, quote unquote, create shareholder value? In other words, make the stock price go up? Or is it to deliver on its value proposition to its customers? Again, if you don't have customers, you're not going to have a share price unless you have the support of the government, which one high-flying firm right now does. But let's take them out of it for now. What is the underlying mission of a firm? I think it's, again, to deliver on a value proposition to your clients in a way different than your competitors. Now, that is a very contrarian view. Many executives come up through the operational side of the business And if in a publicly held firm, they're under significant pressure to quote unquote produce earnings, hit your numbers, produce earnings, hit your numbers. And these things have a way of kind of taking on a life of their own. And as a result of that, only the people who are kind of in tune with that way of doing things rise to the top jobs. In my current book, I say very early on that a lot of the things I'm advocating, are not the way to the corner office, because it's completely different than many things that are happening today. So if you do them, if you're not careful, you could get fired. You could find yourself stagnant. It's very, very difficult. So if you really want to take on a contrarian, unique view and not follow the rat race of the public markets, you not only need the intellectual and frankly intellectual framework and personality to make it happen, you need subordinates who are similarly trained, and you need a board of directors who's going to support you. Case study on how to do that is Buffett at Berkshire Hathaway. And again, I'm not saying Buffett does everything right either. I'm just using him as an example. He, the way he structured his firm and how he's chosen some directors and his employees, I mean, there's a balance. He doesn't have to kind of play to the market. He's created it in his own way, and you either want on or you don't. And he's very clear about that. You want on, I'll do what I can for you. If you don't, go away. God bless you. You're on your own. Very few executives will do that today. Younger executives kind of coming up, studying their own business, have the opportunity to kind of do that. But it's very, very difficult for a seating executive in a firm to take an alternative view and not want to get on the earnings treadmill if that's the way his company has always done things, and that's the way their business model and operating model is geared. It's very, very difficult. Not a happy ending there. I don't see it changing relatively soon. It may, if we get a very severe financial panic and there's a macroeconomic disaster given the state of the national debt, which is approaching 28 trillion. I mean, there's a lot of risk out there. And I know some very, very intelligent investors who are trying to protect their clients and their money under their care from that. But until something like that happens, it's the rare executive who's going to be able to, play the game the way they want to play it with the long term in mind and not kind of kowtow to monthly or quarterly earnings. Sorry, I don't have a better answer for you.
Thanks, Joe. We have a question from Christopher Brande, and he's reflecting on the fact that railroads changed commerce and society, and today it's the tech industry that's doing that changing. And he wants to know how Gould's management of his balance sheet contrasts with today's cash-rich companies, for example, Apple.
So a couple things, right? The economies in the 19th century and today are almost 180 degrees different. It's very, very difficult to kind of compare them. However, like the central logic of have a clean balance sheet, do not play the debt credit game, especially during boom times. Have a healthy dose of cash on your balance sheet so you can be very opportunistic when opportunities arise, has a great deal of value, and it has a great deal of historic strategic value too in the past. It is not something many students are taught today. That's one of the reasons why the Gabelli Center and Fordham are doing what they're doing. There's clearly kind of a need in the marketplace for kind of this type of thinking. That said, right, there are people like, the Tisch family, Carl Lindner of American Financial, Prem Watsa, John Malone, who do know it. So these principles do work in the present, they have worked in the past, and I'm very, very confident that unless something truly catastrophic happens economically, they'll continue to work in the future, regardless of the sector, so long as they're applied appropriately and skillfully.
Thanks, Joe. Richmond Bates wants to know, the UP went bankrupt in 1893. Did that have anything to do with Gould's management or his passing on? So why don't you tell us, is there a postscript?
Yeah, he was out, right? Like as I talked about earlier, and he managed it for 6 years and then he cashed out. What you can say is that when he did cash out and left, perhaps things went the other way, right? So what I mean by that is think about what we talked about earlier, and I'm going to share my screen again, which will make it easier. So again, Gould had it for 6 years following the crisis of 1873. 20 years later, there's a problem. It goes bankrupt. He's out of the picture. While I do have books on the Union Pacific that go back to that time, I didn't study after that because my focus was on Gould's management. But you take out this kind of strategic insight that that Gould had, especially enabled by the margin of safety. You reverse some of his financial things and you start loading it up with debt again under the argument, hey, look, interest rates are low. Let's take on a lot of debt and put the money to work and we'll make a lot of money. You take a more siloed approach to management. In other words, you're not balancing investment, finance, and operations. You take the more imperialistic CEO role of like you're not humble and you're not going to clearly communicate anything. You're going to iterate. You're not transparent. And all of a sudden, after a time, instead of producing results that compound, you find yourself in trouble and you find yourself in deep trouble. So one of the things I talk to kind of clients about isn't just how to leverage things like this from a performance perspective on the way up, but it's how to watch for them from a risk perspective so you don't have a problem when either the market flatlines or when the market comes down. And I don't think the Union Pacific kind of did that going into the 1890s, in my opinion.
Joe, there's lots of questions about comparing Gould to different people. For example, Carl Icahn, Rockefeller. Question about would Gould be similar to an activist investor today? So maybe just if you could reflect a little bit more on who he was and how he fit in with maybe some contemporaries of his time.
Yep.
And how he might fit in with some contemporaries of our time. I know that's a big question, but
no, it's a great question, Donna. Thank you. Whoever asked it, thank you for that. So John Rockefeller, the founder and executive of Standard Oil. In my opinion, he is one of the two greatest American corporate strategists of all time, Warren Buffett being the second. I mean, just how he built that firm, and again, very, very transparent. When he would buy a competitor, he'd be upfront, take the stock, don't take the cash. Take the stock, I'll make you wealthy. Very transparent, communicating. Not many people believed him, many didn't, and then had kind of sour grapes, but he built an absolute empire and actually made even more money from it once the government broke him up. Just strategically, he doesn't get enough attention as he deserves. Gould wasn't that level of strategist, in my opinion. He had more of a trader's approach to strategy. He would try something. If it didn't work, he would immediately cut it and go on to something else. Now, he created, basically the modern railroad network has Gould's fingerprints all over it. So I'm not saying he wasn't creative. I don't think he's at the level strategically of a Rockefeller or a Buffett. Now, with respect to the finances, Gould was pretty much neck and neck with J.P. Morgan. And the Carl Icahn comparison is a very good one because Icahn's a very, very brilliant financial strategist. I don't think he's as much of an operator as Gould was, in my opinion. Brilliant investor. He's very good on the kind of the financial side as well, but it's kind of that operational side. And he's not much of a, I mean, he can trade, but he's much more known as a distressed, longer term investor. Where Gould stands apart from all those guys is his breadth, right? Is he an investor or a trader? People focused on what he did with respect to, the gold corner, they're going to term him a manipulator, a trader, a speculator, whatever, and how he kind of tried to play Grant to kind of get that. But then you look at what he did in the UP and some of his other railroad holdings, they're almost like two different people did it. And on the finance side, he was probably neck and neck with JP Morgan when it came to financial skills. And that's no mean feat. And then operationally, he was just a better operator than all of them. He did all of those things, and he frequently moved in and out of them very, very quickly, sometimes deploying them simultaneously. There aren't many people I know of today, even today, who can do that. So I hope that answered your question. It was a great question, and if we weren't so short on time, I would talk more about it.
Well, we're going to try and squeeze in a couple more, Joe, if that's okay. We got a lot of questions here. This one, it says Stuart Sedlacek. I think it's our board member, trustee Vern Sedlacek, but he asks, what is your opinion of the approach the U.S. government took to encourage the development of transcontinental railroads in the second half of the 1800s? What lessons from that approach could help shape the approach and role of the government today to develop more forms of, for instance, clean energy?
Great question. I have like 2 minutes. Oh God. So, when I said earlier that, Gould wasn't perfect, and we're certainly not perfect. The people that make up the government aren't perfect either. We're all human. We all have our strengths and weaknesses, and we all do things that generate consequences, some intended, some not intended. The government is such a massive participant in the marketplace that its consequences are massive, both intended and unintended. And you see that with the Union Pacific into what's happening today with clean energy. And by the way, I'm for that. We only have one planet. It's in all of our best interest to take care of it. And the fact that it's the 21st century and we're still on a 19th century fuel source, it doesn't make much sense to me. The question is, like, what role should the government play? I don't like, as a taxpayer, seeing a lot of my tax dollars wasted, and they're wasting quite a bit, especially today. So what I'd like to see, and hopefully Biden will do this because he does have a platform for it, is set up some type of, just like we talked about with regulation. Let's kind of survey what's been done in the past, what we're thinking about, what we're doing now, what we're thinking about doing in the future, what worked well, what didn't work well, and really give some thought at the outset to what we want to happen, and then track it. The government is absolutely atrocious at tracking the consequences of its policies. Is it working? Is it not working? In business, we have to do that because we have the profit and loss statement. Again, assuming you're not a governmentally sponsored enterprise where you don't really need to worry about the bottom line. But if you're not that, you have to worry about the bottom line. I think if the government would again, try to rationalize what it's doing, take lessons that learned from the past, try to apply them, and then absolutely keep track of like what's working, what's not working, and then fix the things that aren't working, I think we'd all be in a much better place. And look, I think the national balance sheet kind of requires more, that an approach like this is adopted soon, because as Alexander Hamilton said, debt could be a good thing, but too much of it, there's going to be a tipping point. No one really knows, and I'm paraphrasing, no one really knows where that tipping point is, but everybody understands it's there. And the one thing I know for sure today, as we approach a $28 trillion national debt, not $28 trillion national debt, we are much closer to the tipping point today than we ever have been. And hopefully we can pull back from that.
Joe, I'm going to sneak in the last question, and then David will come on to close us out. Question about Gould. Was he a philanthropist? A little more insight into other aspects of his life.
Yeah, I'm not. That's a great. Yeah, he did do some things, and again, Maury Klein covers it in The Life and Legend of Jay Gould. I would, for those of you interested in him, I would recommend that book. I don't recall the specifics, I was struck by, literally how much of a family man he was. Like he didn't want to go out with the boys and drink. He didn't care. He wanted to be home with his wife. He wanted to be home with his children. I mean, I'm a family man too, so I like that part of him. As you can see from, I have a lot of books in this library. I have 3 libraries in my home, so I'm an avid reader too. So he had a lot of things that I kind of liked. He did do certain things. I wish I could answer your question, but I don't know them off the top of my head. And instead of trying to think my way through it, just refer you to Maury's book for that. And thank you for that question.
Joe, thanks so much. What a wonderful quick passing hour. I'm going to leave the final word to one of our viewers here today, Michael Kwachka, who says that after listening to you today, it sounds like Da Vinci, he was the Da Vinci of 19th century American capitalism. And so an interesting analogy or close, pretty high praise indeed. And high praise to you, Joe, on behalf of the CFA, Fordham, and the Museum of American Finance. Thank you so much for kicking off the 2021 season. And to all our viewers, please check all of our websites and you'll be back for more, I hope. Thanks again.
Thank you. It's been an honor.